35. All right. All right. Hello, everybody, and welcome to Selfwealth Live. You might have just caught the end of that conversation. It was talking about how hot it is in Victoria versus New South Wales. How's the heat over there in New South Wales at the moment, Jace?
It's been pretty hot. Been pretty hot for the last week. We've got storms and stuff as well. So Sydney's become quite tropical these past few years, and that continues.
Yeah, well, it's a different case here in Victoria. We have, as always, there's 2 or 3 days of winter and then 3 or 4 days of scorching heat. And I was just talking about how one time in my room here, I didn't have the air conditioner going. I didn't have it working, and I probably didn't see it to the viewers, but I was sweating a little bit. So anyway, let's move on and welcome everyone to the show. Welcome to you, Jace, once again. Welcome, newbies. Welcome to the people that have been here with us for all this time as well. Great to have you back. Hi, Mark. Hi, Bob. Say hello to us on the chat as well. That'd be nice to see you can hear us and see us. And if there's any issues, obviously let us know. We're here for another week of our Selfwealth Live Technical Edition with Jason McIntosh on your left, and I'm Roger from Selfwealth. We're going to go through, obviously, the markets in general. So the Aussie market, the Hong Kong, the US market, and then the Hong Kong. All right, we're going to talk about some questions or answer some questions if you've got any general questions. And then we're going to have a look at your tickers, as many as we can get through, because we get quite a few of late. So, please feel free to put them in. I'll probably put a cutoff of around 10 to 1, all right? And I'll put that in the chat as well so everyone knows and people aren't putting them in after that time, right? So, but we'll see how it plays. All right, Jace. Well, looks like it's going to be a great show, I'm predicting. But first, we've got to start off with our great disclaimer. If you could please show that.
Yeah, quickly before kicking off into the show, just a note that everything we do today is general commentary only, no personal advice. So general commentary only. And I just quickly put up this brief note, and that just goes through all that, licensing details, all of those important things. I'm also not part of Selfwealth. My business is Motion Trader, so my details are at the top, Selfwealth beneath that. And yeah, as we say, that general commentary.
Beautiful. All right. So as you know, we go live every week. So we do our best. We do our best to go through as much sort of information around charts as possible. If you didn't know, I work as a relationship manager here at Selfwealth. So I speak to a lot of clients, Jace. And before we get into the markets, we were just talking about this before off air. There is quite a bit of a mixed camp at the moment. It's probably testament to what we're seeing on the charts, right? But a lot of clients are also awaiting this crash, a bit fearful of what's going on at the moment. What are your thoughts around that?
Yeah, I kind of like that there is a bit of concern and a bit of maybe skepticism towards the market's advance going on, and that kind of comes through in some of the price action we're going to talk about in a moment. It's when you get this general feeling of overconfidence and that you can't go wrong buying the dip. That's probably when I get more concerned. I like to hear a little bit of nervousness out there that people, it just shows there's not a lot of complacency. I think complacency is a concern when it comes to markets. But when there's a bit of fear, a bit of nervousness, I think that's generally a good thing and a sign that the underlying movement of the market is probably still to the upside.
That's great. Well, speaking of upside, let's have a look at that upside on the Aussie market to start off with.
Yeah, well, okay, we'll go to the charts because this will show some of what we've just been discussing. And so I've got the ASX 200 up here. And so are we setting up for a new all-time high in the ASX 200? I think this is a really interesting situation. So what I want to do here, I want to go back and I want to focus on what's been happening since the December low. And what you see is that we've got this series of strong rallies over the last couple of months. And those rallies are separated by several short but sharp sell-offs. The most recent, of course, was just a couple of weeks ago. That was all due to the talk of the possibility of tariffs. Before that, it was about Chinese AI. And before that, it was concerns about interest rates and the speed at which they may or may not occur. And but look at what's happened after each of these sell-offs. There's been the dip has quickly been bought, and prices have then moved up to new highs. And I think this tells us a couple of things. So, firstly, and this gets back to what we were talking about a moment ago. Firstly, I think there's an element of nervousness amongst a lot of investors. So the market rallies, there's those factors we just went through, something comes out and there's a quick sell-off. So that's a sign, I think, of nervousness. And so this doesn't appear to be a complacent environment where bad news is just brushed off and ignored. There is a bit of a reaction to it, but then the dip is bought. I think that's positive. The other point to note is that the underlying interest, that there is that underlying interest in buying the market on pullbacks, as we've seen on several occasions. So from my perspective, I think the dominant theme has been buying the dips, not selling the rallies. And that's an important distinction, that we're not in a phase where the rallies are being sold. We're in a phase where the dips are being bought. That's bullish. The key structure remains the rising moving averages. So I've got the 50 and the 100-day moving averages up here on the chart, and rising moving averages where price is above moving averages. That's associated with bull markets. And I think that while this condition is present, I think trying to pick the top or trying to pick tops in the ASX 200 is a losing game. It's been a losing game over the last over the last year. Plenty of people try picking tops along the way, but it's been a losing game. When prices are making new highs and when they're above rising moving averages, the odds simply favour that there are more highs to come. I'll quickly jump over to the equal weight. So this is the ASX 200. Let's have a look at it on an equal weight basis. And I think what we're seeing through the last few months, I think this supports a bullish case for the ASX 200. Just look at the latest price action. We've got from the January low, we've got a strong rally off that January low, and the rally has paused just below the all-time high. So this blue line I've got above the market, I've got that there just really as a reference point because that marks the all-time high in the equal weight. That was back in 2022. And so prices have paused just below that all-time high. I think that I like last week's price action. So this is where prices have just pulled back to consolidate the recent gains. So strong rally off the January low, pull back to consolidate. And consolidations are important, Rog, because this is what helps avoid situations where a rally gets really stretched and becomes unsustainable. So getting these pauses within a rally is a good thing. And also look at how well the equal weight's been holding on to those recent gains. So again, look at the strength of the rally, and then it's holding on to the gains. It hasn't been a quick give back of that rally. So again, that's positive. And I think what's positive about that is it just shows that buyers are stepping in on the pullback. We could see some more backing and filling below the all-time high. Maybe prices trade sideways for a little while. Like, for instance, we could get a situation where prices just could get a few weeks of sideways price action just along the moving averages, and then that could be what sets the market up for then a break higher. It could still be several weeks off, but I think that's what the odds are favouring at this point. My view is that this is an environment to be long stocks and be actively looking for opportunities. I'm looking for stocks which either have emerging or established upward momentum, and that's really what I'm doing with Motion Trade. I'm doing those daily scans and I'm looking for those stocks which meet that criteria, and that's across the 2,000 stocks in the ASX. And this is where I think the odds favour you get those best gains with the lowest risk profile. And I'll be managing my portfolio, managing my stocks with those wide trailing stops we always talk about. And the aim of them is to see off these consolidations. Consolidations are normal; they're a part of every advancing market. The wide trailing stops, it just helps see them off and stay on those or stay on those broader trends as the market moves higher. But at the moment, I think that's the path of least resistance to the upside.
Yeah, beautiful. Actually, I'm going to go off a point that I made last week. I think it's fascinating that the market has literally paused, well, 3 times basically off the all-time high, and it shows a huge, not just technical level, but a huge psychological level for the market as a whole, right? We don't know what's behind it all, why it would just stop there, right? But there's some reasoning there. But going off the back of what I was saying last week, back in the past, in my technical analysis days, I would look at this as almost like a triple top now and a potential for a big fall. Now I'm looking at a completely opposite, based on what we've learnt together, and not trying to predict too far ahead, but just seeing it as it is right now. And, that there's that third push forward and then that small push up last week, which to me, hopefully, or for us with stocks, will be positive and stay on the upside, right? So it's a really good point that we keep on reiterating here, not to try and predict too far in the future with technical analysis as well, right? So, yeah.
Yeah. So look, technical analysis isn't meant to be a crystal ball. And it's interesting because people will look at this chart in different ways. As you just said, some people will look at this and go, look, okay, well, there's a triple top. This is this market's peaking. It's going to struggle here and it's going to come back. Whereas I look at this and I see a holding pattern. I see a market that's rising. It's gone into a holding pattern, which or another word for a holding pattern is a continuation pattern. So you get upward momentum, you get a pause, and then you get more upward momentum. There's no guarantee that's going to happen, but I think that's what the odds favour. So it's a bit like are you an optimistic person or a pessimistic person? And I've learned over the years with the market that it's better to side with the prevailing momentum and be optimistic that it can extend higher rather than be pessimistic that something that has been working is now going to stop working. Now, at some time, this will stop working and it will peak and it will fall. But I think you make more money being optimistic that it will extend because that's what it does a lot of the time. And when it does fall, we can manage that risk with stop losses, trailing stops, those things we talk about. But whilst it's working, let the thing keep working. Don't get in the way of something that has been going in the right direction. Just go with that momentum, go with that trend, give it room to move. And that's where the money's made. The money's made by a trend going further to the upside rather than trying to pick all the tops along the way.
Yeah, good, 100%. Let's have a look at the US market then. What is that looking like?
Okay, so S&P 500, and I think this has been a pretty important week for the S&P 500. The bullish trend had another test to the downside last week, and that was with all the talk and threat of tariffs. And we actually saw a 3.5% swing from Friday's high to Monday's low. So 3.5% in a couple of days is a notable pullback. And once again, the dip was bought and prices have moved back up. And that's not the first time the market has come back from a seemingly bearish development. Just remember back here on the 10th of January, we had this false break, this little consolidation pattern along the moving averages, and we briefly got the break to the downside. And that was on the back of a strong employment report. And there was then talk, now interest rate cuts are going to be delayed, so the market sold off. But the breakdown was short-lived, and we quickly got that rebound. Something similar happened after you can just see through here in late January with the emergence of that Chinese AI advance. That brief sell-off, which again was bought, prices went back up. What we currently have is a market that seems to be resilient to potentially bearish developments. So those three events I've just noted, they're all potentially bearish developments, which in a different situation could send the market lower and continue lower. But that's not what's happened. And when a market can't sustain a sell-off, and when selling doesn't attract further selling, which it hasn't on these three previous occasions, I think it's a sign that the bullish theme remains dominant. Just looking at the price action, the S&P 500, it had a strong rally off this January low, strong rally off the Jan low. We've now got this corrective-looking zigzag formation. Let me just sketch that out. So from the high, you can see the the classic zigzag, where it makes a low, rallies, makes a new low, and then rallies again. We often see that during corrective periods. I'd also add that this pullback is choppy and is overlapping. And again, that's typical of consolidations. And importantly, it's held on to most of the gains from the January low. So look at the advance from the January low. Most of those gains have been held, and the market is still holding at those higher levels. So that's a sign that buyers are stepping up to accumulate on these dips. Just quickly, I'll throw in a Fibonacci retracement. So these are useful. Fibonacci's are interesting, and they give a guide to proportion of a pullback. So you use the low point, and then you use the high point, and you project that higher, and then you get this range in here. In the middle is 50%. And then you've got 38.2% at the top and 61.8% at the bottom. Just look up Fibonacci retracements if you want more information on them. And often we find that pullbacks come back within this zone. That's what's happened so far with the S&P 500. So it's been a well-proportioned pullback to this point. And this is around the level where a new rally could very much begin from. Of course, the overriding consideration for me is the price structure. And when we compress this and look at it, there's the 100-day moving average, there's a 50-day moving average. These moving averages continue to rise and price remains above the moving averages. So again, that's that bullish price structure. Betting against the bullish price structure usually doesn't end well. So go with the trend. That's my approach. We can quickly jump over to the NASDAQ just for a brief look. And this is interesting because you can really see prices are coiling up along the moving averages. So prices have rallied. They've been going sideways along these moving averages. This type of price compression, in my experience, it typically resolves to the upside. So I think the odds favour that this sort of setup will resolve in higher prices. Again, no guarantees. Good-looking setups can turn south and break down, but I think the odds favour a break to the upside. And again, this isn't to say that the trend won't change. It invariably will at some point, but at this stage, everything we can see points to the trend remaining up. So that's where I think the money can be made with going with the trend. For me, it's a case of being focused on what's working, giving the prevailing trend the benefit of the doubt, and then managing risk. We've got to always be managing risk. It's not being just blind to one scenario. Got to manage risk, and if there is reversal, and when there's a reversal at some point, that's where I've got my trailing stops, those wide trailing stops. I want to be able to see off the consolidations for as long as possible, but then have that plan for selling when the trend does ultimately break down, whether it be sometime soon or somewhere much later or somewhere in between. That's my get out. That's my my plan for selling when things do turn south.
Yeah, beautiful. And that's one of these, once again, just to reiterate that point. And if you're a newbie watching this this show, whilst we're quite bullish at the moment with the charts, we always, like Jason specifically, is always about managing that risk, right? And if you've never had these lessons before in managing risk in your portfolio, then please go and have a look at some of our shows around that in the past and just review that, because as a newbie, and all the newbies that I speak to as well, sometimes we never speak about this. They never know about this and never hear about it, read about it in forums, and it just becomes a disaster for most people, right? So, and it just tarnishes their whole experience in the share trading world. So, but of course, all the guys on chat probably know this by now, and they're well versed in managing risk. Let's have a look at the Hong Kong market.
Yeah, well, this has been a really interesting week. This is the sort of price action we've been looking for. Last week, we were talking about tentative signs of buyers starting to be more active on the dip, because we had this rally from below the moving averages to above, and for the first time in several months, we'd seen the dip being bought, as opposed to the rally being sold. And then this week we're now starting to see an acceleration higher. This week's rally breaks a sequence of lower highs. So we had this series of lower highs in place. We've now broken that sequence, and I think it leaves in place a corrective looking structure. So we've got an impulsive rally during last year. This long persisting pullback. Market had its chance to break down in January when it broke below the November low. That dip was quickly bought, and now we've got, as we've discussed, that quick turn higher. I think the Hang Seng is now set up for a run back towards the October high, and then potentially beyond that. I think this is a move which is worth going with. Yeah, it does look like there is more upward potential in this market. When we look at China, however, it's just not getting the same traction as we're seeing in the Hang Seng, and you can see prices are still stuck below these moving averages, which have been rolling over. So that still leaves it technically vulnerable. But I think the positive here is that the Chinese market has been holding up. Like, it's not breaking down. Just because it's vulnerable doesn't mean it's going to break down. What I think is positive is that it is holding its lows from the last month, despite all this talk of trade wars and the impact that could have on China. I still want to see this back above the moving averages and start breaking above some of these previous high points to just break that, to show that sell cycle has been broken. But maybe the fact that it is holding up despite those factors we just went through, and also that we are seeing that strength in the Hang Seng, perhaps that's giving us a clue that there is a potential rally building in the in Chinese stocks, which is probably like when you look at what's happening in Europe and the US and Australia. The signs are telling us that the bullish phase is still intact.
Yeah. Okay, well, that's probably about one or two times we've been pretty. We started to get bullish on the Hong Kong market, which, as you say, is good signs. Jace, don't forget that if you've got a Selfwealth account, you can trade the Hong Kong market there, or any of the stocks on the Hong Kong market for that same fixed price brokerage that we offer at Selfwealth. Now that's the plug for the moment. Let's get on to some questions, Jace, if that's okay. Thanks, Jennifer. Thank you for telling me that I look smart. I appreciate that. I don't get that a lot. Got a lot of sort of questions in here, but I'm going to start off with a question from George, which we received via email. What stocks do you avoid in your system, Jason? Is it based on price minimum, market cap, or average turnover? What kind of criteria do you use for stocks that you would avoid?
Motion Trader is set up to scan the entire market, so all 2,000 stocks. I do have various rules in place that help filter out a lot of the low price stocks, like 2 cent, 3 cent, 4, 5 cent stocks. They tend just to, like, whilst you can get some really nice trends from some of those low price stocks, on the overall, they just tend to add volatility to a portfolio. So I use a volatility filter to remove those lower price stocks. That said, there's nothing wrong with looking at like a low price stock. If you're got a bit of a chart eye and you can use moving averages and you can use breakouts, you can get a 5 cent stock that trends really nicely and becomes a 20 cent stock, becomes a $1 stock. There can be some terrific gains. But there's so many of them out there, and most of them just flounder and really go nowhere. So it's a harder end of the market to be looking. You really need to have a good mechanism for going through and scanning those stocks. Volume wise, I'll look at volume. I think the advantage we have as private traders is that, or traders / investors, is that we can consider stocks with lower levels of liquidity. So if you're a fund managing a few $100 million, you can't. It's going to be really hard to go out there and do much with a $40 million stock. But as a private investor, we can look at those smaller stocks. Market cap wise, I don't have a limit where I'll look. I'll look at the bid and the offer. I'll go to the Selfwealth account and I'll call up market depth. And I'll see what's on the bid, what's on the offer, and I think I can move in and out reasonably. Well, I'll consider the stock. So if it's going to take, if I look at the bid and offer, and there's like two offers or two bids, I'll probably say, look, this stock's just too hard. But if there's a reasonable prospect that yes, I can buy it within a few cents and I can sell it within a few cents, well, I'll consider it. And this is the advantage of having those relatively smaller parcels of shares to move around. So I think some of the most exciting opportunities come from those smaller stocks. A lot of those, like you look at the emerging companies index, and that's made up of companies ranking between 350 and 600. So you just think anything below 500 isn't included in the All Ordinaries, which is a top 500. And for most people, they're not going to know those names. Stock 500 through to 600, they're names that are going to be foreign, but there can be some terrific opportunities in them. And even stocks a little bit further back, ranking 700 or 800, I tend not to buy anything really ranking below 800 just because there's a lot of stuff out there which is just illiquid or 1 or 2 cents. There's no trends. But yeah, be open. I'm very happy being open to those smaller opportunities.
All right, fantastic. Good response. Let's then, now we've got quite a few ready to go through. So let's get started with our tickers then. We shall start with one from Mark, which is SM1.
Well, I haven't heard this one for a while, and now I can see why I haven't heard it for a while, because it's been in this big downtrend for several years. So it's really easy to like filter a good large percentage of the ASX, because you look at the chart, the stocks below the moving averages. Don't worry about it. Just walk away and look at other things. There are better opportunities or higher potential prospects out there, and what's happened in more recent times, so it's now flipped to the good side of the moving averages, and the moving averages have turned higher. So this is an interesting setup that we have now, and this comes after 6 or so months of just tracking sideways. So that looks like a basing structure there. It's broken higher. It's this is a stock worth considering. So let's just work out some risk on it. So I guess it could be bought at current levels, because it does seem to be like we do have, like we've got the moving averages are positive, prices breaking higher. Where do you put a stop? Well, I'd probably want to have a stop at least back below the 50-day moving average. So that's about 28%. So it's a bit of risk there, but it's asymmetric because the upside potential is significant. It'd be possibly more aggressive on the stop loss. Like we could use this low point from just a few days ago and a little bit more than that. So maybe around 19-20% could work as a stop loss, but somewhere between there, probably somewhere between 19% and below the 50-day moving average would be a reasonable stop loss, and see whether this momentum kicks. So if the momentum kicks, great, let it run, then use a trailing stop. If it could also pause here and just have a lengthier sideways period while the moving averages catch up. That's why I think you need to give it a little bit of room if playing it. But yeah, certainly one to give consideration to.
All right, fantastic. Let's have a look at GNP then.
Yeah, I've got this stock, and I like the way it's currently set up. And I always say, just because I've got a stock doesn't mean it's a special stock and it's going to do extra well. I've got I buy plenty of stocks that don't perform, and I sell them relatively soon after. It's it's a numbers game. I just go through the setups, buy them. If they work, keep them. If they don't work, put them out, and just keep circulating that way. But this is one I've had for a while. It's been doing well. It's been rising with these rising moving averages, and then over the last what would that be? The last 4 or 5 months, we've had this consolidation, sideways consolidation into the averages. We've got rising, generally got these rising lows, which shows I think the buyers keep bidding the price up, and the selling has really been capped around this point through here, around pretty close to where we currently are. I think this is on the verge of breaking higher from this sideways consolidation, and you can kind of like, this isn't a perfect line, but you can kind of it just gives a bit of a visual on the range. I think there's upside potential here. What would ways to play it? It could be bought maybe on a breakout just above last week's high, then a stop back below the January low, which would be just below the 50-day moving average. If it's in a portfolio, I'd be happy holding it. So I'm happy holding my stake in the stock. Good example of those smaller stocks where nobody knows their name, or just about nobody knows their name, of how they can produce great gains. Like, look at that from a stock which you can see it's a lower volume stock by the patchiness and the price action. But it did give a buy signal, and then it's become more liquid as the share price has gone up. You can see the price action is not as patchy now as it was back in 23. More interest in the stock, more volume in the stock, and it's gone from down below $1 to currently up just below $3. So great opportunities amongst those stocks, which most people don't know if you have the ability to scan and identify the opportunities. And that's the part that catches most people out. They can't scan the market. They don't know where to look, and they get stuck just focusing on the top 50 or the top 100 because it's more accessible getting some information about them. And they can be great investments, but there's also a whole lot of interesting stuff outside those big names as well. So, yeah, the power of being able to access what's out there, Rog.
All right, GMP is looking good. Let's have a look at LYC.
Yeah, so it's a stock I've watched for quite a while, looking for an opportunity. It does look like there is the potential of this being a big basing structure in Linus. So we could say, like, could this be like a rounding base sort of structure? It doesn't quite fit in with the with that the arc I've drawn, but just generally speaking, you can see that it's like we've got this series of lower lows, and now we seem to have signs of that we've got rising lows. It's a bit messy through here, but the most recent low is still above the July low, so it does have that general rounding shape. Is it ready to go now? Well, I don't know. Like, we could have looked at it with the same lens when it broke higher in mid-January, and then it fell again. So I think there's something building. Whether now's the time, I'm not so sure about. I'd probably prefer just to watch the price action a little bit longer. Let it get a bit higher, then let it consolidate. Like, the next consolidation could tell us a lot. So if, like, the rally we got off the December low, it didn't do a good job of holding its gains. It gave them all back. So if we get a rally this time and it does hold on to those gains and hang around the moving averages, well, then that could set up for the next leg upwards. So I can see the potential of something building. I'm not quite ready to play it yet. If somebody wanted to be a bit more aggressive, maybe it could be bought now with a stop below the low point from just a few weeks ago. That could be like maybe 15%, 14, 15%. So it's asymmetric in that the potential of the stock is that it does go on a large rally at some point. But yeah, that would be probably the more aggressive play, just buying, going, okay, I can get it here. I know where I can have a relatively low risk stop, and see whether it runs. Or the more conservative way is wait for the next consolidation, see what it looks like, and then maybe buy a breakout from that. But yeah, definitely worth being on the radar.
All right. IMB.
Well, it's consolidating below these declining moving averages, so it's there's vulnerability with it. It had again another low volume stock which has become more active as the price has gone up, and we have had this nice trending phase. Problem is now we've got this sharp decline in October, and it's just really consolidating near the lows. So the risk always is when you get this consolidation below the moving averages that it does have another leg lower. So at the moment, if I was in this, if I was in this from good levels, say I'd got in when we got these initial breaks higher, I'd keep holding it. I'd keep holding it if it was still above my wide trailing stop. Let me just put on a 10 ATR stop and see where that might be in this stock. So this is an initial breakout point. No, well, look, on a 10 ATR stop, it would have already been an exit, and from a 25% trailing stop, it would have been an exit. So I'd actually be out of this stock. I would have sold it on that initial sell-off, and I wouldn't be buying this dip at this point because it's below the moving averages. If I didn't sell it on that first sell-off and I'd saw it bounce and it's now going sideways, look, I could have a stop loss just below the recent lows. But I would want to have an exit point worked out on this, because what can happen with these stocks, and this isn't a prediction for what this one will do, but this is what the sort of thing that can happen. They can break lower, and then they just keep, you get this constant decline that just keeps going. Now, again, this isn't a prediction for this stock. This is the risk. We've got to understand risk when we're holding stocks. What's the risk? What if I'm wrong? What if it doesn't rebound? What if it keeps falling? So this is where I want to know, okay, where's my line in the sand? Where do I press the sell button? And for me, if I hadn't already sold it, I need to avoid the possibility of getting stuck in this sort of decline. So that means I need to exit if it breaks below these recent lows. Finding it down here at 25 cents and going, well, now what do I do? It's fallen so far. I don't want to sell now. It's too late. All these arguments then come into play. So I don't want to be there. So the only way to avoid that possibility is to cut it sometime without giving it too much more room to move. So this would be on, as I say, I wouldn't be in it. And if I was in it, I'd really be thinking about where am I getting out, and not buying this dip. It's below moving averages.
All right, beautiful. Let's have a look at the next one, which would be Suncorp.
Yeah, trending nicely. Trends in place. It's just a nice uptrend. This is a. If I had this one, I'd be certainly holding it. It looks very much like the financials index. It's trending well with those big banks generally. We've got this pullback. Maybe that was an ex-dividend, because that little drop we've got there. I don't know, but nonetheless, it's a pullback back towards the moving averages. It probably could be bought at current levels. So I look at this recent little holding pattern. So it rallied up, a bit like we're talking about triple tops earlier on, Rog, where people would often look at them as sign of a topping pattern, whereas I prefer to look at it more as a holding pattern. And look, you got another one just through there. So get these pauses to the moving averages. And we've recently had a breakout from one. It's pulled back to the breakout point. So it's probably a buy the dip opportunity as well for anyone who is interested in this sort of stock. Could be bought at current levels, probably with a fairly close stop, like maybe even just like a 7% stop, 7 or 8% stop just below the 100-day moving average is maybe a lower risk entry point for a stock like this, which is in an ongoing trend. So it's not an emerging trend. it's an ongoing trend. But you can get into these ongoing trends, and the place I like to get into them is after consolidations, when it's breaking out from a consolidation. That can be the entry point, and people will say, "Oh, look, it's gone too far. I've missed it." And like, who knows how far this could rally? Maybe it is getting near the top, or maybe it could go another 50, 60, whatever percent. Who knows? We don't know. So it's like going with the trend until the trend is over. At this point, the momentum is certainly to the upside.
All right. Next one in financials as well is QBE.
Similar in that, like the overall trend is to the upside. If I had this, I'd be happy holding it. It hasn't been as nice a trend as Suncorp, because it has had more of these pullbacks below the moving averages. Suncorp has had a stronger trend, but nonetheless, this has been a trend which initiated all the way back here in 21. Let's throw in a 10 ATR stop out of interest to sort of see how this has played out. So so that initial entry probably would have been stopped potentially. But then since there, had we got on a slightly later stage, let me just measure that as well. Actually, the motion trader stop would have seen off that pullback as well, because it gives it at least 25%. So from this initial entry point back in May 21, this has been a completely tradable trend. And look at these pullbacks along the way. They've all been survivable pullbacks, staying with the trend. So if I was in this stock, I'd stay in this stock and let it keep running. Potentially buying the dip, and there's also the potential of buying at current levels, buying the dip and seeing whether it extends, stop maybe below the 100-day moving average. It doesn't look like a standout buy to me, but the trend is certainly up.
Okay. The next one will be PNC, please.
Well, we've had the makings of a trend, but it's not. This is a deeper pullback that we're currently experiencing. It's below the moving averages, so it's not a dip that I'd want to buy it at this point. If I was still holding it, maybe I could use the maybe the low point from December. Like, I'm going to go back to my ATR stop. Yeah, so from an ATR stop basis, it's still a hold. So if I'd bought that initial breakout, I'd be happy to continue giving this the benefit of the doubt, because we do have that underlying momentum in place still. But the longer it spends below these moving averages, with the moving averages starting to turn down, the vulnerability increases. So I'd know my exit point on this one. My exit point would be below the December low. If it gets below there, well, I'd say, look, it's not working out. I'd just take the money out, put it elsewhere. But if it can hold these current levels and get back above the moving averages, well, if I was in this, I'd be happy staying in it and see whether it can regain that momentum. But it's not a stock I'd want to buy at the moment. I'd want to buy it when it was in a stronger technical position than sitting just below moving averages.
All right. Next one is SPZ.
Yeah, trend here is up. It's been a really nice trending stock for some time, and it's really worked quite well along the moving averages. You see, we've got these periodic pullbacks to the averages, but it's a strong trend because it doesn't then spend much time below the averages. When it gets back there, it tends to find support. The dip's bought. We might get a holding pattern, but then it re-engages the upward momentum. There is an ongoing consolidation happening at the moment. Whether this is gearing up for another breakout or whether we get some more sideways, I don't know. Of course, it could also break down as well. But I think, as we've been saying throughout the course of the show, the path of least resistance in these situations is to the upside until proven otherwise. I'd be happy holding this stock, wide trailing stop below the 100-day moving average. Look, if someone liked it and wanted to get on board, maybe this consolidation is the opportunity to buy it and then have that stop. Maybe you could have maybe a 10 to 20% stop. So somewhere between we've got the lows from late January below the 50-day moving average to below the 100-day moving average. So 10 to 20% stop, and see whether this momentum continues. But yeah, if I had it, Rog, I'd be continuing to hold.
Nice. FND.
No. This would be a no for me, and I'd be also out of it. So we did have a nice trend. Trend really accelerated late last year, but then it came really quickly, came back, and this was deep enough to take out even a wide trailing stop. So I'd be out of this one. It has found some support, and we're having a rebound. But is this going to be a case of it's bottomed and it's going back up, or is it going to be a case of like sell the rally back to the moving averages and it starts to move lower again? So there's too much risk around this one for me in terms of where is the dominant trend now. Do we have a trend change? We've gone from above moving averages. We've gone from above moving averages to below moving averages, and we're currently consolidating just beneath, a touch above today, but essentially I'd still call these declining moving averages. So I'd pass on this one for now. If it can get a bit higher, breaks that downward momentum back above the moving averages, come back and relook at it. But at the moment, it's I just put this one to the side, and I'll as I say, I would have closed my positions probably somewhere in December, and just be out of the market for now.
Okay. The next one is from Kirby, VCP.
Was that BCP, Rog?
V.
Is that it there, VCP?
No, because it's not on one of our exchange, not one of the ones we look at. Maybe Kirby, give us some clarification on that one. We'll move on to the next one, which is actually one that I wanted to know about as well. AIM.
And happy to look at the international ones as well if it is on an international exchange. But just let us know when you give us a ticker which exchange it's on or which country it's in.
I think that's the one.
Yeah. So look, the problem here is we're now below the moving averages, which are rolling over. So this had been a really, really nice trend. We had the consolidation into the averages. We do have the breakdown. So it's not a dip I'd want to buy. If I had it and I'd seen off that sell-off so far, I think my stop would then have to be below the February low. Like I've got to draw the line somewhere in this one. If I wasn't using a calculated trailing stop, if I was just looking at the structure and working it out as I went, I'd have to say, well, look, if it breaks to a new low, I'd have to sell it, because I look at like my, like what are the possibilities? One of the possibilities is that it breaks to a new low and it continues making lows, and an unacceptable situation for me would be to be holding it in several months' time or 6 months' time, whenever it may be, and the price is down in the 30-cent region. It'd be like, for me, that'd be a very disappointing outcome. So the way I can avoid that is by having a stop loss below the current low. Of course, that removes the potential of a rebound, but it's not the stocks that rebound that cause me trouble. It's the ones that continue falling. That's the ones that tend to weigh down the portfolio. So I'd have an exit plan in place for this one now. If we get more consolidation below the moving averages, we might see a weaker structure start to develop. But for now, it'd be certainly not a buy, and I'd be really considering what my exit strategy in this one. It comes down now to I want to manage my risk. I don't want to be focused on what it might do in the future from an upside perspective. I've got to bring it back to, okay, now what's my risk? How do I manage it? How do I protect the majority of my capital, which is still in the stock?
All right. We just had Kirby meant the volatility contraction pattern, not the stock ticker. So we're probably talking about when we were looking at one of the previous tickers or markets. Let's move on to the next one then. XRF.
And volatility contraction pattern would probably be one of those compression patterns I talk about, where we get those holding patterns where the price action starts to compress. I imagine that's what Kirby was talking about. Now, this is looking, it looks good still. So we've got this ongoing upward trend, periodic pullbacks to the moving averages where the dips are being supported. Still appears to be finding support around the moving averages. Is this one of those holding patterns or compression patterns towards the moving averages that resolve to the upside? I think that's what the odds would favour at this point. This is also a buyable dip. It could be bought at current levels, and risk around this is pretty straightforward. I'd be using probably the lows from the lows from January, a little bit below that, maybe a 10% stop. So maybe this could be bought at current levels with a 10% stop. It's a nice asymmetric trade because if it starts to rally, well, I think we can say it's got the potential of at least three times that risk that we were looking at, 10%. It could go at least 30% or more, and that's always could. It's like there's no calculation to measure how far a stock's going to rally, but there's no reason to say, well, there's like this would be an all-time high for break. So it's clear sky above there. So it's got the upside potential, and we can work out the risk management. So it's a stock which I think would be worth considering. And if I had this one, I'd be continuing to hold it.
All right. I think this one will be an international one. SMCI. Yep.
Well, it's been an avoid. It's a strong rally off the lows, and it's back above the moving averages. But the moving averages are still trending down. It's going to take. This is a thing when you use 1,500-day moving averages. They don't turn higher after a good week. They take a bit more time to turn around. And the advantage of that is that it does help you avoid some short-term rallies which quickly fizzle, and the bearish momentum then renews. On the flip side of that, it gets you into some stocks. It gets you in slower. You get a later entry trigger. For me, looking at this, it does look interesting. It could be the start of something, but chances are, even if this is the start of something, even if the stock rallies a bit further, at some point it is going to likely, if it remains positive, it is likely to pause and could rally further, but then at some point it would probably then pause to consolidate, and that's when you get the moving averages start to turn higher. I'm just like roughly sketching some in. The moving averages turn high, they cross, and then the breakout above there, that can be the trigger to entry. But that could still be several weeks or more away before we could get price action like that. So I'd be inclined just to wait at the moment. Like if someone's more active and they're using a 10 and a 20-day moving average, well, maybe they're in, and they can manage the risk around that. But for my purposes, with the longer term moving averages, I'm not ready to step up for this one yet. It's one which I think is worth watching. But I'll give it a bit more time, watch the moving averages, watch the next consolidation, see whether we get a setup like I was describing to maybe get in the weeks ahead. But if someone got on this early, well, great. Easy point for me to put a stop loss would be below the February low. And that's probably not that far away. What would that be? Oh, actually, it is. This is the thing when stocks jump quickly. That's the lows. It's 47% above the low. So this is where I'd like to wait for the next consolidation, because it then gives me some points to manage risk around. So if I bought it here, where's my stop? It's like maybe below the 100-day moving average. But yeah, I'd just wait for now. Interesting stock though, Roger, to keep an eye on.
All right, thanks for that. MMS, is the party over, do you think?
Well, I think the party ended a while ago, and the police have now turned up at the door. It's it's look, we got this the moving averages crossed back in May, and price has been below. We got the consolidation below the moving averages, which we always talk. That's the point of vulnerability. We had the breakdown from there, so that was the official time to go home. We had the breakdown, and now it's continuing to deteriorate. We're getting the rallies are being sold. The rallies back to the moving averages are being sold, and it continues to sell. It's not a stock I would have been in for a while now, and I certainly wouldn't be buying this dip. It's just, for me, this is just all risk. I don't want to try and pick a low on it. If it makes the low today and it fires up again, well, that's all well and good. But I think the odds do not favour that. I think the odds favour we're going to see lower levels. It's for me, protect capital and look elsewhere. We want to be in stocks when they're on the good side of the moving averages, not when they're on the wrong side of the moving averages, and that's where Macmillan currently is.
All right, let's have a look at AZY. The low price and it's consolidating 10 to 1 soon. So taking that into account.
Yeah, well, this is like we spoke about these really low price ones early, and you can get these nice trends in them, but they're just it's a difficult area of the market to operate in because there's so many non-performers that give false signals and then come crashing back down. At the moment, there's the makings of a trend there. I don't know about the corporate actions, how they're going to play out. If I happen to have gotten on this one early when it got above the moving averages and started to get some momentum, well, I'd be happy keeping it and have a stop loss below the 100-day moving average, see where it goes. A lot of the time, these rallies don't really turn into anything big, but you never know. You only need a handful of these low price stocks in a portfolio to really shoot the lights out, and you can have a significant win. And so it mightn't matter that you're going to have lots of ones that fall back on themselves if you can manage risk effectively. I wouldn't buy it at current levels because the risk is just, I'm looking at 30% stops, it's just getting a little bit too much. But look, Rog, if I had this one, there's momentum to the upside. It's one that could be held with a stop just back here at the 100-day moving average.
All right, the next one along the line is TTM.
Was it TTN?
TTM.
M.
Mary?
Titan. It really had something nice going on around October. Like at this point here, we would have been talking about, I would have said, look, this looks great. We've had this initial rally sideways into the averages. It's breaking higher. This is looking good. I want to be long, have my stop below the 100-day moving average. But then it's broke down, got back below the 100-day moving average. I probably would have closed my position. We've got some consolidation beneath the averages, so it got vulnerable. But now it's just starting to get back above the averages. So it's broken that sell cycle that started to develop late last year. And so that downward momentum is now gone. The immediate vulnerability of being below the moving averages is now passed with price back above the averages, and the averages are starting to turn higher. So it's coming back onto the radar as a prospect again. And some of these emerging trends are messy. They don't all deliver us nice, clear-cut trends. They can get us in and they can get us out, and then they can turn higher again. And some of them you just get whipsaw in. You get in, you get out, you get in, you get out, etc. How this one plays out, I don't know, but I wouldn't be rushing if I was looking to get back in. I wouldn't be rushing back in at the moment because you could see more sideways consolidation. I'd probably like to see a little bit more strength. The moving averages cross, get another consolidation, and then look at it. I don't think this is at this point, I don't think this is a standout stock. It had a really good setup last year that failed. I'm probably not in a hurry to jump back into it at this point.
All right. IDX.
And this is an interesting one. So we've got this consolidation going on along the moving averages, and that follows a nice trending period. So is what we're seeing now going to resolve the same sort of way as this consolidation did back mid last year? Had a push higher into the end of last month. It's since been just pulling back towards the averages. So the holding pattern remains in place. And we can actually can draw it up. And that's pretty much the parameters of it. So I'd be looking at this with a bullish bias because the prevailing trend has been to the upside. I'd be looking at this as a holding pattern and that the next move will be a break to the top side, that we do see price action that looks something like that. But of course, that hasn't happened yet. It may not happen. How to play this? Well, firstly, if I had this stock, I'd continue holding it. I'd have my wide trailing stop. I'd know where that is. It'd be somewhere back below the 100-day moving average and some, so giving it plenty of room. The dip could be bought at current levels, and an initial stop loss, a conservative stop loss, could be conservative in terms of not wanting to lose much money. Could be as little as like 5 or 6%, just below the lows from, when was that? In January. These lows from January, and that would take it below this lower boundary of the range. So that would be that's one way to play it. Another way, so that would be to buy the dip play, and my preferred play at this point would probably be to buy a breakout above the upper boundary. So maybe up around $3.20. So I'd probably buy the breakout. So a couple of different ways to play that, depending on how you're currently positioned and what you're looking at doing.
Okay, the next one is WA1.
So I've looked at this before, and I've already got the range drawn up. So this is the thing with preempting a breakout, in that sometimes a breakout doesn't break out; it comes back within the range. It's like this one's still in the holding pattern, so I'd be leaving this alone for now. I'm looking for me, this would be a breakout trade. I'd like to buy a break above. I would have probably been looking at the November high. Now we can use the February high, which is pretty much about the same sort of level. So we're probably looking at about 1760 something as a breakout, and then the stop loss could be back within the range. And whilst it's in a holding pattern, I don't need to put the capital in there. I can just watch and wait. There's nothing to say it can't break to the downside. So another strategy would be to buy current levels and just have a stop just beneath the previous lows. So that's not too far away. That's it's reasonable still. It's about 18%. So if you buy current levels, do you want to risk 18%? Punting that we're going to get a break to the upside. Some people will say yes, and there's nothing wrong with that. That's a valid thing to do because we can measure our risk, and if we're right, our upside is a multiple of that potentially. I'd probably prefer to play the breakout for now. So watch for now, buy the breakout.
Okay. TLX.
And that's the thing with these things. There's no one right way. There can be various strategies that are valid and protect risk and give upside potential. So there's not one right way. It depends how you want to play it. It's like a poker game. You can have a hand and you can go, okay, well, I'm going to keep those cards, throw those ones out, but someone else would do it slightly differently. There's no one right way to do these things. Other than, of course, manage risk. That's a clear cut. You've got to have a plan for that. Now, looking at TLX, yeah, this uptrend remains in place. It's been in place for a while. If I had this, I'd be happy holding it. We're getting this consolidation now, which is not surprising because it has become a little bit stretched above the moving averages. Probably wouldn't be in a hurry to buy it just here. I'd just give it some time to see what the consolidation looks like. See if it can hold on to these recent gains off the January low. If we get the sideways consolidation, it's holding the gains, moving averages are catching up, then it probably becomes a buy the dip play. But for now, this is a hold and have the trailing stop somewhere below the 100-day moving average.
All right, let's have a look at one of our favourites from last year, DRO. Has that made any recovery?
Yeah, no, trend remains down. So I had some DRO and I sold it back mid last year. I think I sold it into the rebound. Can't quite remember, but it was somewhere mid last year. Yeah, this is the thing. Once a boom stock peaks, it often doesn't regain that upward momentum anytime soon, and you can have this long, slow deflation, which continues to unfold. I'd leave this stock alone. I wouldn't be trying to buy it, hoping for a return of what we saw during 24. That was extraordinary. That doesn't come along that often, and Drain Shield may not go through another period like that again. It could, but it certainly doesn't look like it's going to be doing it anytime soon. The boom story around it has now passed, and it's now there'll be people who were holding at the high, which are still holding and hoping for a return. But I think the better play is, as we keep coming back to, it's managing risk, saying, okay, we're now below moving averages, prices moving lower. It's time just to take this one out of the portfolio, put the capital into a new opportunity, which is above the moving averages. This continues to be a downward trending story.
All right, let's move on to PMV then. P for Paul. So PMV.
There we go. Is that it? PM for Mary?
Yep, that's the one.
Yeah. This is where the stop loss gets helps get you out. It's like a gap lower. If I'd been in this stock, so this was a stock which had been trending higher. It's unusual to have a stock reach, what was that? Like that could well be an all-time high. It's unusual to have a stock at an all-time high, and then 5 weeks later be gapping lower. It's reversals often take a bit more time for a top to form and the price to break down, and you get a bit more of a warning that things are losing their momentum and becoming vulnerable. But it does happen. We do get these surprise turnarounds where the company makes an announcement and the bottom falls out. It does happen. This is why I always suggest people focusing on having many relatively small trades, not just 3 or 4 big bets, because the problem is when one of those big bets comes apart rapidly, it can cause a lot of volatility to a portfolio. So really spreading risk is part of a risk management strategy. Stop losses are one part, spreading risk is another part. If I was in this stock, I would have had a stop loss that would have triggered on this first gap down, and I would have closed it and gotten out. I certainly wouldn't be in it now. I wouldn't be buying it now. If I was in it now, the focus would be getting myself out. Maybe I'd be using this rebound as my opportunity to save some capital. Now, of course, the stock could continue to recover, and someone could sell now and go, "Oh, geez, oh, that's annoying. I've sold now, and the stock has recovered." But that's going to happen. What's going to happen if it continues to deteriorate? It's like this is where people get stuck and they end up holding stocks all the way down. So I'd be really looking now at protecting capital in this one and getting myself out.
All right, let's look at this micro cap AS1.
Yeah, look at this. It's a small stock with potential. It's gone from below the averages to above. I like the structure of the consolidation. We've got the sideways move into the averages. You can see the buying of the dip pushing it up, pullback which held on to most of the gains. Now it's got another rally. So if I had this, yeah, I'd keep holding it. If I was looking to buy it, well, this is probably a point to consider buying it. Stop loss, looking at a decent stop loss. You're looking at probably a 30-odd% stop loss back to the 50-day moving average. Preferably hopefully if it had a consolidation would hold hold around those recent lows. It's a bit messy to see this the way the drawing works, but you can see this low point from a couple of days ago. Maybe a pullback could hold there. Essentially you want to see it hold on to its gains. So if it can had that initial rally, if it can hold those gains, then maybe it steps up again. So yeah, it's an interesting stock. Interesting price structure. I know nothing about it. It could completely flop. That could be the high and it could just come down, but we can have that stop loss. If it does get some momentum, it's one of those ones which could go a long way. So worth having if you like this end of the market and you're interested in the price structure, it might be worth having a look at.
All right, we'll do the final three. I think PXA.
Well, this is where vulnerabilities turn to another sell-off. So this would be a no from a buying point. I certainly wouldn't want to buy this dip because it's now a case of the rallies are being sold, not the dips are being bought. So a weak technical structure has turned into a decline, and not everything that looks like it could be like if we looked at this back here, I would have been saying, look, we've got a consolidation of the moving average. We've got some momentum turning. Yeah, this is a stock which has some potential. Stop loss back below the moving averages, but not every stock which has I say this quite a bit. A good setup doesn't mean you're going to get a good outcome. It just means it's a good setup which we can manage risk around, which has upside potential. They don't all play out. So this one's gone to the downside, consolidated below the averages and broken down. So how do we manage that? Well, I'd manage that by selling it, taking a relatively small loss fairly quickly and moving on to another idea and just keep looking for those ideas until we get one which really, really runs. Let it keep running. This is the cost. Stocks like PXA are the cost of finding the next big uptrend. And you're going to get, I think, anyone who's successful in markets and who actively manages it and closes out their trades that don't run, they're going to get lots of PXAs in the portfolio. So I'd just leave this one alone for now and look elsewhere.
Well, let's look at CAT then.
Well, this has been a terrific uptrend in this stock. I've got this one. I've had it for a while. I don't remember where I bought it, but it's somewhere way back here, and the trend's still in place. We've just had this consolidation through December into January. Your classic sideways consolidation to the averages. Another breakout. It's a stock. So I've got it. I'm happy to keep holding it. Would I buy it here? I'm less inclined to want to buy it here given how far it's already run, given that it's gone from where the first breakout may have been. Let's just say it's gone from $1 to $4. Could it double again? It's possible, but then it really does start to become one of the great trades. If it were to double again from $1 to $4, now double, it could happen. But it's a lower probability situation, I'd suggest. So I'm less inclined to want to buy a stock which is this extended. Theoretically, it can keep going, but I just know from back testing and looking at lots of stocks, other than like 5-cent stocks that go crazy, which rarely happens but can happen. For a $1 stock, you typically don't find they've gone up 2,000% over 3 or 4 years. That I don't see that very often at all, if at all. So I'm probably less inclined to buy Catapult at current levels. But saying that, I'm very happy holding it with my wide trailing stop below the 100-day moving average.
All right, we'll finish off on this one. BVS, please. BVS. And then one general question, which should be pretty easy to answer.
This sideways compression looks like it's getting close to breaking to the top side again. If I had this stock, very happy to keep holding it. Would I buy it at current levels? Well, it hasn't actually broken out yet. We've just had a return to near the moving average, and it's rallying again. It's a potential buy at current levels with maybe a 15% stop below the recent low and below the 50-day moving average. So yeah, look, it's a potential buy. There is underlying momentum to it. It's been a sideways consolidation, path of least resistances to the upside. Happy to hold it. Yeah, consider buying it.
All right, fantastic. One general question, Jace, regarding your 10 ATR stop, what period do you use?
Offhand, I don't remember. It's probably a couple of weeks. Probably like 10 to 15 days, something like that. You'll find if you do some back testing, it probably won't make a great deal of difference whether it's 10 days or 20 days or even 30 days. It's going to be. I don't think it's going to make a huge difference.
Will it be in your setting if you put your interactive ATR on there? No.
Oh well, this will just be the default that that'll just be the default that TradingView uses. I haven't set it up. I've just set the one up in TradingView just as a general quick reference point, 10 ATR. But it's probably TradingView is probably using around 10 days. And you'll find if you just get the TradingView software and you play around with it, put different parameters in, put in 10 days, put in 100 days and a few things in between and see what difference it makes. And you might find that movement from 10 to 20 is pretty similar.
All right, beautiful. Thanks for that, Jace. Thanks for your insight. Thank you, everyone, for your questions and tickers and commentary. Much appreciated, as always. Don't forget that anything we do or say here on this show is general advice. You should always be doing your own due diligence on the stocks that you are either wanting to buy or sell. All right. So we do love hosting this show every week. But we also, on a serious note, we also got to make sure that you do take this as general advice only. All right. So be sure to check out our services down below. You've got Jason at motiontrader.com.au. Check out the link down below, and you got selfwealth.com.au as well. And you can use the link. And if you've never been a client before, you can try us out for free if you want down below. Don't forget to also like and subscribe and comment on the video as well. If you've got any questions, you can use the comments below and we'll try and answer them in the next week's show. Other than that, Jace, it's been a wonderfully long show once again. Thank you once again for your time, and thank you everyone, their viewers, for their time.
Yeah, thanks, Rog. Thanks everyone for joining us. It's been fun as always. Look forward to next week.
And we will see everyone next week. Take care, everyone. Bye-bye.